Now we're going to go over some miscellaneous items regarding materiality, just some other points I want to make sure you're aware of. Materiality thresholds do not apply to fraud involving management. Here's a point. Now, if a cashier, so a low level or normal level employee, steals $100, that would not be material. However, if management, and whenever I say $100, I've said it before, but I do mean, generally speaking, this is going to be a small, not a big deal, well below materiality. We're dealing with large companies here. However, if management steals $100, that's a big deal. Even if materiality is $1 million, $100 is quite small compared to that. The issue here is that even immaterial fraud on the part of management indicates more serious issues with management's integrity. If they're willing to steal something, then that's indicative of there being other issues, and we need to investigate that. Management can't do any fraud at all. Sorry, management. Don't feel bad for you, but that is what we're dealing with here. Materiality also does not apply to the effects of a direct financial interest in the client on a CPA's independence. Independence is impaired if there's a direct financial interest in an audit client, regardless of materiality. What does this mean? If you are on an audit team that's auditing, I feel like I use the same examples all the time. Let's say you're auditing Amazon and you own any Amazon stock. That is a breach of independence, regardless if it's one share and materiality is, $1 million, right? That would still be not allowed. Now, when you work at a firm, generally they have programs where it tells you what you can't do because you're on this particular client that is taken care of and tells you what stocks you cannot own. Lots of processes and procedures to make sure that you submit what stocks you own through a portal, which says, hey, you're not allowed to own these shares because there's some connecting issue there. This is not allowed at all. Now, throughout the years, an entity may have had multiple immaterial misstatements. This is what I was referring to earlier. The auditor should consider these in the aggregate and how they affect the current year. While misstatements may be individually immaterial during a year, altogether these misstatements can become material. Said if every year there's an immaterial variance, you need to look at them in the aggregate, and there are automated ways of doing this because that does sound like a lot of work, right? It definitely does. So you would monitor that and ensure that there's a great usage for the permanent file as well. You could have a tracking tally of all the materiality thresholds and the materiality differences and variances between what the financial statements should be throughout all the years, so you can assess this critical point every year. As we mentioned before, there are both quantitative and qualitative considerations when determining materiality. Now, both of these need to be taken into account for an audit. As you can probably figure, quantitative numbers don't lie. They're much more straightforward and easier to use. However, we also need to use qualitative considerations. Quantitative considerations include the size and magnitude of an item, while qualitative considerations include the nature and circumstances of an item. Now, nature and circumstances you can't really quantify. That's why these are qualitative. And the size and magnitude work best as a number. The auditor must use professional judgment to determine what is material to the financial statements as a whole. Even if something falls below numerical materiality, the auditor may just say, hey, it makes the most sense, right? We want to make sure that users of the financial statements have no risk of being misled. This could be material in the future, so let's still test this account significant. Component materiality. Here's a concept I want to cover. Component materiality is the concept that an auditor should consider the materiality of each individual component of an entity, which could be segments, departments, subsidiaries, when determining the overall materiality for the purpose of the audit. Now, we're taking into account these treating them kind of like they're different entities in the sense of determining individual materialities for each component. In order to reduce the risk that the aggregate of undetected misstatements in the group financial statements of a non-issuer exceeds the materiality for the group financial statements as a whole, an auditor should establish a component materiality that's lower than the materiality for the group financial statements. Essentially, if you've got different departments, you got different segments, different, maybe geographical, you've got companies branch in the US, companies branch in India, companies branch in Brazil. you want to make sure that you have materiality for each of those components for each of those segments. And that's going to obviously be lower than the materiality for the financial statements as a whole for the whole organization. Last slide here, documentation of materiality. The auditor should include in the audit documentation, which I've got a gorgeous lesson waiting for you there, the following amounts and the factors considered in their determination. First, materiality for the financial statements, pretty clear, right? We should just document the number. I mean, that's definitely a given. If applicable, the materiality level or levels for particular classes of transactions, account balances, or disclosures, which we know is performance materiality. So this is overall materiality. This is performance materiality. Well, also, what is performance materiality? Why is that double stated? This is from the ASCPA authoritative literature, so I don't know. You can ask them. And then any revision of the above points as the audit progressed. So any changes, as we mentioned, you can have changes to materiality. You want to document those for yourself, for others who review your audit. Always put everything in writing. Don't leave anything up to chance. All right, let's wrap it up and have a good time with this lesson. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.